Greg Cameron, President and Chief Financial Officer.
Good afternoon, welcome. It's great to be together for our third investor conference. We have over 70 people here in attendance and hundreds more streaming this event online. Thank you for your interest and support of our company. Today, we'll share how Bloom is uniquely positioned to be an energy leader in the transition to net zero. You'll hear about our superior technology platform, the robustness of our operations, our ability to scale, and how we deliver profitable growth. As KR just laid out, the mission of Bloom has remained constant since our founding. The company was designed and developed to meet this moment. He said, this is our time. We have the solutions, the maturity, the manufacturing readiness, and the financial capacity. Over the next couple hours, we're going to share our perspectives, plans, and targets. But you're also going to hear from industry leaders, partners, customers, on how Bloom's unique solution is addressing the most pressing energy issues of our time. Let me just start with a couple financial highlights. We are reaffirming our 2023 framework, as we did on the earnings call 2 weeks ago. We are maintaining our 2025 guidance for gross margins, operating margins, and service gross margins. And we are confident in our long-term forecasted revenue growth. Now, there will always be movement in the numbers around segments as markets develop, but we are well positioned to deliver through 2031. Begin with that revenue framework and how we're growing our top line 30 to 35% over the next decade. We set the target that by the end of 2031, Bloom would achieve an annual revenue of $15 to $20 billion a year. The projection was built on delivering on our historical growth rates in power generation, which has been 25 to 30% as we grow in our current markets and add new geographies. We're on track to meet these growth targets. In 2022, we achieved $1.2 billion in total revenue, with our product and services revenue up nearly 28%. This year, we're targeting $1.4 to $1.5 billion in total revenue, with product and service revenue up 26% at that midpoint. This has been all power generation business. The need for our product is growing, our commercial positioning is improving, the geographies we're in are expanding, and we have the capacity to meet this demand. You'll hear from Tim today on the progress that we're making in our power generation business in our international markets. Over the course of the last year, we moved very quickly from landing our first servers in Europe in June to securing 5 new countries. The themes of needing sustainable, resilient, predictable power are resonating with even a greater focus on energy security. We see opportunity to accelerate both in Europe and in Asia. In addition, we see tremendous opportunities for our decarbonizing technologies. As proven in our electrolyzer demonstrations, we have developed the most efficient electrolyzer on the market in converting kilowatt hours into kilograms of hydrogen. We have a 15-year proven track record, operating this platform as a fuel cell. And we have the operational readiness to deliver over 2 gigawatts electrolyzers annually. Hydrogen is an undeniable reality. You can see with this momentum the capital and stimulus going into this market. To us, it's always been a question of when, not if. The Inflation Reduction Act's hydrogen $3 PTC is driving increased commercial interest in the United States and setting the bar high in other economies like Canada, Japan, Korea, and the European Union. You'll hear a lot more today on why we're so excited about this opportunity. In addition, as the world secures the zero carbon energy needed to produce clean hydrogen, we have a technology to enable efficient carbon capture. Given that we don't combust, there's no particulates, no SOx, no NOx in our exhaust. We are 95% pure CO2 from our anode exhaust when the water's removed. There's a huge opportunity for us to partner with players from multiple industries to provide 24/7 baseload zero carbon energy at very attractive economics. Economics made more attractive with the $85 a ton incentive from the Inflation Reduction Act. In addition, we're seeing strong interest from industries that utilize CO2, like SAF, in their production process. And as KR said, should the pace of the adoption accelerate, our carbon capture application could provide a significant upside to our current projections. On transportation, specifically marine, we're developing the technologies to grow in this market. There's a tremendous need to decarbonize with clean fuels, and while there's a longer development cycle for this product, we see this market significantly contributing later in our 10-year framework. These additional applications should add at least another 5 points of growth, bringing our overall revenue growth to 30 to 35%. And if the world moves more quickly, we'll be ready with product, increasing these rates. Our total addressable market is measured in trillions, trillions with a T. And you'll hear from today, those global markets are trending in our favor. There's growing need for resilient, available power that reduces carbon intensity today while providing the optionality to move to on-site net zero solutions like hydrogen in the future. The effects of climate change will increasingly impact the aging electricity grid with outages, while utilities lack the power generation and the transmission resources to meet the needs of a growing global populations and economic growth. The gap is going to increase additionally with the needs of a digitized economy, electrification, electric vehicles, and a warming planet. What's unique about Bloom is the products as a platform, specifically designed for multiple applications across the same core platform. It's incredibly important as you think about the prioritization of our investments. As we invest in growth, we're not dependent upon a specific fuel, an application, or geography. In addition, leveraging the core platform is incredibly important when you think about our cost down learning curves. But our story's not about growth alone. It's about profitable growth. We have targeted to get to a 30% non-GAAP gross margins and 15% non-GAAP operating margins by 2025. That's just 2.5 years away. I'll walk you through how we intend to get there momentarily, but at its core, it's about leveraging the power of a common platform to drive down product costs, combined with OpEx discipline and leverage across the platform. We are committed to achieving this target, and you should see steady improvement towards this over the next few years. This year's guidance has a commitment for us to be non-GAAP from operating income positive. Last year, we were within $30 million of hitting that target. We took all of that frustration from the team and the whole business and doubled our efforts to make the business profitable this year. We've made it a goal of the entire company, and every Bloom employee has an incentive to help meet this goal. We understand that in a high-growth company, once you get to profitability, you unlock tremendous operating and value leverage. We're also committed to being cash flow from operations positive this year. As I detailed out in our earnings call, we used $315 million in cash from operating activities in the first quarter, primarily driven by investments in inventory. The time to power value proposition and leveling the build plan resulted in net increase in inventories. We also had an increase in our receivables as our EPC partner finalized their project financing. We are on track to collect the receivables and ship our inventories, and we fully expect to recover that working capital as we move into the second half of the year. 2 weeks ago, we secured $560 million net proceeds of additional capital at very attractive terms. We did this to ensure the company is well positioned for the future. We're going to pay off debt, and it's going to provide us the capital to drive our growth, especially as you see more and more large-scale projects that require greater and longer investment cycles that are going to have movements in our working capital. We raise this capital with an instrument that has an exercise price above $26 a share. Let me go through the numbers here. So at the end of the first quarter, we had $320 million in unrestricted cash. The convert proceeds add $560 million to that balance. We're going to use $200 million of it for debt repayment. When you get the $315 million back to get us back to CFOA positive over the next 3 quarters, and we're going to use roughly about $95 million in CapEx for the remaining part of the year. That should give us a pro forma balance targeted at about $900 million by the end of the year. On the debt repayment, we're currently evaluating repowering our one and only remaining consolidated PPA. If we choose to do it, PPA 5's 40 megawatts, we'd expect similar outcomes and benefits to the 30 megawatts of repowerings we completed in 2022. For completeness, I've included that $120 million in this debt schedule, cash schedule. Throughout the company's history, we've consistently achieved an annual cost down reduction in our product cost 10 to 15% a year. As the world experienced the aftermath of the COVID pandemic, the impacts of inefficiencies, inflation, shipping costs, and capacity investments resulted in a unit cost increase, product cost of 7% last year. Hadn't happened in our history. Now, we weren't unique in this regard, and the aftermath of COVID had similar effects on other companies. However, we used it as a rallying cry for the whole business. We reinvigorated our efforts on engineering costs out of the product, increasing power densities, driving automation in the factories, and reducing costs in our supply chain. While costs were up year over year in 2022, each quarter we had a small decrease as these initiatives started to take hold. I was really encouraged by the first quarter this year when we were down 10% versus the first quarter last year. We're on our way to a 12% cost reduction target for the full year 2023. Reducing product costs is key to us continue improving our margins. We firmly believe we can continue to leverage these efforts further and drive down this cost curve and return to that 10 to 15% annual reductions. It's important to remember that the benefits of a common platform is these cost savings translate in reductions to all our applications, including electrolyzers. While we optimize the application, it remains the same basic design, and this allows us to use the same supply chain, manufacturing capacity, logistics, engineering teams, and learnings across the entire platform. We are building manufacturing capacity to meet demand. Last year, we were excited to have you all at our new manufacturing facility in Fremont for the investor conference. Over the course of 2022, we increased our stack manufacturing capacity in California from 300 megawatts to 660 megawatts. You'll see in Jose's video later during the roundtable, this year we wouldn't have been able to hold this crowd in that facility. It's filled up with tooling. We can add at least another 700 megawatts in that facility, and we can do that as we need additional capacity. At our projected growth rates, that should be enough capacity to meet demand for the next 3 years. In the near term, that team is focused on automating and optimizing our manufacturing processes so we can reduce costs. We'll talk about this more during the roundtable. Another encouraging data trend is we've been able to maintain price. The need for our product, especially with our time to power value proposition and the improved ITC benefits, have allowed us to capture more value. Clearly, the price utilities are charging is increasing significantly, with many territories up double digits. While we always will ensure that we're selling our product to our customers at a competitive solution, the drivers for value of resiliency, sustainability, and predictability of receiving power is increasing. Sherilyn will speak more about this. It's not solely cost savings versus a local utility, but rather our solution versus lost opportunity of not having the required power or certainty of power. We'll retain our strong pricing discipline as we evaluate new markets, and we're always going to allocate units where we get the best combination of margin and growth. In addition to reducing our product costs, we expect additional operating leverage in our operating costs. Over the past few years, our operating expenses have remained about 26% of revenue as we invested in R&D, increased our commercial resources, and ensured we had the control environment to scale. While expenses in the first quarter were elevated by some very specific program spend, for the year, we expect to be 200 to 300 basis points lower to about 23% for this year. As the development of our platform matures and our commercial investments scale, we're seeing enhanced operating leverage. For example, we expect to grow our operating expenses less than 12% in 2023, about half the rate that we've seen in the past. Going forward, we will maintain similar levels of annual growth. Now, when you combine that with our expected revenue growth, this should allow us to achieve our targeted operating levels of 15% of revenue. This should give us the appropriate level of investment in R&D and commercial, and when combined with our expected gross margin expansion, ensure we get to that targeted 15% non-GAAP operating margins in 25. It's key to that. Let me spend this few minutes on the service business. I know that you guys have some areas of questions around here. There's incredible value in that recurring revenue stream as each one of our servers has a service contract attached to it. We have over $7 billion of service revenue in our backlog at the end of last year. Now, we price each service contract to a targeted minimum 20% return. Over the last couple of years, we haven't gotten there. The business has been impacted by negative timings on some commission cycles, on product cost, and most recently on performance payments. For the service revenue, we've had a greater mix of Korean acceptances. Unlike our historical US business that you began earning service revenue very close to acceptance, there's about a 12 or 18-month delay for our Korea acceptances. These projects, though, are now coming online, and they're going to contribute to our service revenues as they do. Second, we talked about product cost before. Not having the cost down, that impacts our replacement module costs. Now that we're seeing, again, to be driving down our product costs, that's going to translate into the service business and help improve in margins here. Lastly, I explained this on the first quarter call. At the end of last year and through last year, we made a call to ship more units for revenue than for service. And that had a negative impact on our power output, which has caused us to make some performance payments to our investors. We're now quickly shipping those units in the beginning part of this year. At the same time, we're making performance payments. As the power output increases, those payments will reduce, and that should improve our overall service margins. We remain committed to a 20% non-GAAP gross margin in service by 2025, and we see a path to get there. In addition to just the financial return that we see in the service business, we collect over 1 billion data points every day. The data is used to monitor output, identify service needs, or adjust performance. We utilize this data to model changes in our operating variables on efficiency, power output, and stack life. The knowledge that can be applied to the specific system, or it can be either applied to a specific system or leveraged across the entire fleet. The concepts of digital twin, machine learning, and AI are not new to us. We've been leveraging data to improve our product and performance since our inception. These insights have been incredibly valuable as we've matured our technology, our manufacturing, and service. We will leverage these learnings as we move into more applications in the future, such as electrolyzers and marine. To scale our revenue targets, we're going to need to continue to leverage partners. We really want to focus on our core competencies. And for example, we need partners to deploy our technologies for electrolyzers and carbon capture. There are proven technology partners out there that we can line up with and scale quickly with them rather than compete with them. We're taking similar approaches for installation, financing, analytics, and IT. Our best example of a mutually beneficial partnership is SK EcoPlant. KR talked about this last year. What began in 2018 with energy servers in Korea has matured into leveraging their EPC expertise in fuel cells in the United States and global large-scale hydrogen development projects. To date, we've sold 1.2 billion of fuel cells in Korea and have partnered on over 400 million in the United States. On the slide here, we show a picture of our joint venture with SK ecoplant in Korea. We're utilizing this facility for final assembly for our Korea acceptances this year. Korea is a key market for us. The Korean government and the power generation companies value fuel cells as a key component in their energy transition, and we are well positioned to provide both natural gas fuel cells and hydrogen fuel cells as we go forward. We are in the second year of a 3-year volume agreement and look forward to working closely with KI Park and the entire SK Eco team to secure additional commercial wins post that take-or-pay contract. Global government incentives are positively impacting our business, specifically the Inflation Reduction Act. I've talked about the benefits of an increase in the investment tax credit, on the hydrogen production tax credit, and changes made in carbon capture. We see these as tremendous tailwinds in the US, as well as driving additional incentives in other geographies. Let me give you a sense for the agenda and who will follow us today. So Sherilyn will come up next, talk about the power generation business. And then we'll have Tim Swiker coming, talking about both the international and marine strategies. And then we'll have our new CTO, Ravi Prasher. Ravi brings incredible technical chops to the job, and he's going to give us insights around the hydrogen electrolyzer demonstrations. We've got Rick Butel back this year. Rick's a 30-year hydrogen veteran, and he's going to talk us through the efforts that we're having, as well as specific insights from a market leader. Then we'll come back, and I'll lead an operational discussion with Carl Kutuli, our engineering leader, Satish Chichori, our supply chain leader, Jose Hernandez, our manufacturing leader, and our CIO, Cornelia Poole. And then KR will be available to take some questions. Bloom's at an inflection point. The grid's becoming less resilient and more expensive. The world needs to decarbonize. Solutions like clean hydrogen, renewable natural gas, carbon capture, it's the future. We have those solutions and they're in demand. We will continue to invest, reduce our costs, and build capacity. Our mature technology platform can be leveraged across multiple applications. We have the balance sheet strength to deliver, and we're at a very attractive valuation. We are extremely focused on execution. We plan to deliver robust growth at attractive returns and generate cash. We have a clarity in our mission. We're extremely excited about our future. Thank you.